Hey, everybody. Wow, what a market we have had yesterday. The market was up 0.7%, almost a full percent, based on the lack of government shutdown, or lack of, based upon the fact that the government shutdown was averted. And there's a lot of talk about, bubbles and corrections, and I'm one of those people talking about bubbles and corrections. And, I just want to start off by telling you all I am still bullish because I do think that things are improving and the world is getting to a much better place, but financially. But it's relative to where we were. There's no way in the world that we should be at these valuations. And I know a lot of people have a lot of different arguments for that, but let's just look at the facts and the data and let's see what they are telling us, okay? So this is January's data. I have January up from Forex Factory here. Let's start off with manufacturing data, and let's take a look at that. And we can see that, since looks like September of last year, we've been on a steady increase, right? So manufacturing is improving, right? 5.97 was a bit of a beat, and that's great, isn't it? Well, okay, maybe not. Let's look out a little bit here. Look over a larger time frame, and let's see what's happening. Let's go all the way back to 2003, shall we? And we can see back in 2003, manufacturing was much higher. Much higher. And then in 2010, 2011, manufacturing was even higher. So we actually have some negative divergence here, don't we? So if the manufacturing output in the United States, if the stock market is at such a tremendous high, yet are we really growing? Doesn't look like it. Sure doesn't look like we should be at record levels to me as far as manufacturing in the United States is considered. Let's take a look at non-manufacturing. Now, most people are not aware that non-manufacturing actually makes up over 65, almost 70% of the United States GDP, gross domestic product, right? Now, how's that doing over time? Let's take a bigger look, shall we? Yeah, we're doing great, aren't we? So the driver for almost 65, 70% of gross domestic product, it's doing good, but it's actually worse than it was 2004, 2007 levels. Yeah, we definitely, economy's doing great. This market should be booming, shouldn't it? Should be booming, shouldn't it? Now, a lot of people talk about non-farm payroll change, right? How, as far as jobs are concerned, right? Let's take a look. Yeah, good, but nothing spectacular, right? Nothing spectacular. Still not anywhere near all. By the way, guys, for the stock market to be doing as well as it's doing, all of these should be off the charts. All of them should be off the charts, right? And then let's continue here. What about inflation? Okay, if an economy is truly doing well, okay, and I don't know if many of you are aware of this, but the reason why the Fed pays attention to inflation as an indicator of health of the market, right? You can see inflation, as far as the producer price index is concerned, it's non-existent. When an economy is truly doing well, inflation will be higher. Why will inflation be higher? Right? It should be higher because demand should be outstripping supply, right? What about inflation as far as the consumer price index? Let's take a look at that. And again, this is a sign of a healthy economy, is when you have inflation growing at a steady rate. And you can see here, it's a little bit better. But all of these that I'm showing you here should all be off the charts. In order for the stock market to be valued so high, all of these indicators that I'm showing you are what drives GDP, gross domestic product. All right? Okay. Now, let's take a look at retail sales. Okay. Again, a little spike, but this should be like solid. This should look like this, right? This should be like this in here, or like this level right here, constantly growing, right? So retail sales, not off the charts. Okay. Let's take a look at what else can we look at? We can look at GDP. Well, let's look at advanced GDP to start, because all of these things should be driving this. For those of you that don't understand economics, most of you will, but this is just a very simple fact. All of those things that I just showed you up there should be driving GDP, and for the stock market to be at record levels, you need GDP growth that should be, about 4%. And you can see we're at 3%, right? So this is advanced GDP quarter over quarter, right? And you can see it is improving again, but no different than it was in 2014, no different than it was in 2011, certainly nowhere near as good as 2010, right? And about as average as it was for most of 2003 and beyond. Okay? You can look a little bit deeper into durable goods orders, which is more of a short-term indicator. And again, core durable goods orders, not off the chart record levels, right? I mean, the only thing that seems to be of anywhere near off the charts is consumer confidence, right? And this one doesn't have a chart. There's a University of Michigan. This is CB Consumer Confidence. If I go back and find consumer confidence, you'll see that consumer confidence is one of the indicators that is off the charts high a little bit right now. So again, is this bubble warranted? I mean, is the valuation, I won't even talk about PE valuations, right? Price earnings valuations. The price earnings valuations, just so you're aware, I'm not going to actually pull something up and show it to you, but the PE valuations are approximately higher now than they were during the internet bubble. So, I don't know, guys. Can we argue about actual numbers? Right? Can we argue about actual numbers? No, they're right there in front of your eyes for you to see. Is the market, now let's just go take a look at some charts, and let's take a look at the market over that time period, right? Take a look at the spider. Yeah, we should be way up here. There we go, right? This is where we were back in 2002 when the market was actually super good and super strong. And in 2012, 10. Look where we are, guys. Now, I am not calling a top because a top is a very difficult thing to predict. I made another video that says what to look for before we get a top. What I'm looking for in order to get for a top to happen is I am looking for some type of capitulation. Now, if you don't know what capitulation is, it means some massive amount of volume that comes into the market. And I'm looking for sellers, I'm looking for buyers to get into pain. And you can see there are no buyers that are in pain whatsoever. But for anybody that tells you this is not a bubble, you need to explain to them simple data and simple mathematics. Now, there's a lot of people that will tell you, well, you know, it's not really the same thing, and 2009 was not the same, and 2002 we had this. Don't listen to those people, okay, guys? Data is data is data. Those are just people that are creating what's called a new paradigm, right? And if you study bubbles, you'll understand whenever people start saying, well, things that happened in the past don't really matter anymore because we're in a new paradigm, right? When people start telling you that kind of stuff, that's when you know that we are in serious trouble, right? Now, why are we here, right? Why are we here? If we are here, why are we here? I mean, it didn't happen all by itself. What is fueling that bubble? Well, it all started with the Fed after the financial meltdown and quantitative easing and 0% interest rates. And, you know, we really have not been raising rates enough. And here's the bottom line. As long as a company can go into the market and borrow money at a rate lower that it can use that money. Let me write this out for you because it's really important. As long as a company can go into the market, okay, so I wrote it out here. As long as a company can borrow money at a rate lower than it can reinvest that money and make money, then, I always get my thans wrong, either then, I never remember the A talking about time, or is this, whatever. Then, I think that's an E, then the stock market will rally higher for the most part. Let me repeat that. As long as a company can borrow money at a rate lower than it can reinvest that money and make money, then the stock market will rally. Well, why? Why? Well, let me explain it to you in very simple ways. Okay. The reason for this is, let's say I borrow at, I don't know, let's just say 3% a year, right? Right? I borrow at 3% a year. Now, I turn around and invest that money, okay? Now, there's several ways they can invest it. Let's say they invest it by doing a stock buyback program. So what does that mean? Okay, what does that mean exactly? What is a stock buyback program? So I go to the bank and I say, look, money's really cheap right now. My shares, right? Let's just use any company. We'll use let's say Netflix. Why not? It's in the news right now, right? Now, I'm not saying Netflix is doing this because I don't know exactly if they are, but this is how it works. So if I can go to the bank and borrow money when my stock is $32 a share at, let's say, 0% or 1% or 2%, and I do a share buyback program. In other words, I create a trading desk in my company, and I give that trading desk a shitload of money, right? And I say, look, here you go, here's, 20, 30, $50 million. Every time the stock drops, start supporting it and buying it. Yes, that's what happens. Now, if I know my business is growing at the same time, why wouldn't I do that? Of course I would do that, because that's going to be extra profits for my company. So as long as I can borrow money, and then over the course of that year, my stock rises, right? So let's go to 2002. I borrow money, and by the end of the year, my stock is up 100%. I borrow money at 3%. Yeah, that's a pretty good deal, isn't it? Right? And then I borrow money again the next year, and my stock is up 150%. I think I'm going to rinse and repeat that, don't you? Right? Even on a bad year, when your stock goes down a little bit, you really only lose 3% on your money, assuming you're not trading it, right? So as long as interest rates remain low and you have some growth in your company larger than the interest rate that it's going to charge you, that it's going to cost you. So if you borrow at 3% and you're going to grow at 4 or 5%, it's a great deal, isn't it? Right? It's a great deal, right? So what's the other thing? It's not just the interest rates, but you've got to be able to borrow that money, don't you? So money supply becomes the key catalyst. In other words, as long as interest rates are low and the Federal Reserve keeps printing money, then the stock market will go higher, because not only are interest rates low, but there's tons of free money available for you to get your hands on. Does that make sense? So that is why the stock market is doing this. All because, not because of Donald Trump. Yes, some of his policies helped create this last little burst here, because repatriation of all that tax money, and also the fact that he has brought some manufacturing back to the United States, but manufacturing had suffered in relationship to the real GDP driver, which is non-manufacturing. Okay, so Donald Trump did not do this. Okay, nobody but the Federal Reserve, low interest rates, and an unlimited money supply has done this. It has created a market that is devoid from all the actual real data as far as the data is concerned. Okay? That is why the stock market has rallied, for those of you that do not understand this. And that is why, as long as the money supply stays the way that it is, the market is going to continue to go higher. So what is the money supply right now, and when will that change? Well, I'm not going to answer all those questions for you. I just wanted to make this video to I would like you to make this video viral, because I think that everybody needs to understand the real reason, especially you twits on Stock Twits. I love you all. I got, 12,000 followers. Thank you very much for following me. But a lot of you guys are really numpties, and when I see the reasons why you think the market keeps going higher and higher and higher, I don't think you really truly understand, what's going on and how devoid the market has become from actual data. Okay? We are nowhere near these levels. The valuation of the stock market based upon the real levels, once interest rates get back to 5-6%, and that's kind of a magic area, right? The real value of this stock market is probably around 170, 160, right? And will it correct? Will it have that big correction? Yes, it will. Will it happen tomorrow? I don't know. Will it happen in a week from now? I don't know. Should the market be up at these crazy levels? If you honestly believe that, you're drinking the Kool-Aid too much, okay? And if you haven't studied bubbles, hold on a second, let me show you something, because if you study bubbles, let me explain it to you. So here's a little graphic that explains a bubble. I just found it on the internet. So you have kind of what they call the stealth phase, which is accumulation phase. And you have the takeoff, then you have a sell-off, which is really a bear trap. It's the awareness phase. In other words, something great is going to happen. Everything is starting to get better, right? Then you have the mania phase, right? Tons of media attention, tons of enthusiasm, lots of greed, lots of delusion, and they really shouldn't have in here something that is missing, and that is complacency. When everybody starts to believe it's impossible for something to happen because of this new paradigm. It's a different world now. Things are different. This data does not matter anymore. All that data that I just showed you, which is actual facts, and more importantly, GDP growth, which is the biggest indicator of all, is not growing, right? It's a new paradigm. We don't need GDP growth anymore, right? Well, there's certain truth to that, because the truth to that is that, you know, as long as you keep interest rates relatively low, and as long as you keep the money supply to be massively high, the market is going to drive higher because corporations are just going to invest and buy back their shares, right? And even if they don't do share buybacks, what else are they going to do? They're going to buy more product or do more business because it's cheap for them to do that. Does that make sense to you? Okay. Now, I do want to talk about one other thing here to help you understand it, right? And that is the US dollar, right? The dollar index. So let's look at the DXY. US dollar index, okay? You'll see that since 2017, the dollar has been getting smashed as well too. So that's the other factor that is driving this market higher right now. Okay? Why is that an important factor? Well, think about it. If I own Canadian dollars or, you know, Japanese yen or whatever, is it more expensive or is it cheaper for me to invest in the US market and US equities when it's at 103 or 90? It's cheaper, right? So I can, my money goes further when the dollar goes lower. Okay? My money goes further when the dollar goes lower. So that's the other reason why we have seen, don't let anybody tell you, it's all about Trump, 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 Trump. It's nothing to do with Trump. Okay, please stop. Please. You just look stupid. Okay? Yes, policy does make a difference because it does dictate what will happen to a certain degree for the next 4 years. Will it actually work? Well, everybody thinks it's going to work, right? I mean, if you come to Canada right now, guess what Canadians are doing? Canadians are in tax and spend right now. So everybody thinks that tax and spend is going to work, meaning that Canadians are actually raising taxes for the most part and spending more. because they think that by the government spending more, that's going to work. Like, the point being, we don't know if anything that Trump is doing right now is going to work. And how will we know? We will know when GDP grows. Okay, that's how we'll know. And is GDP growing? It certainly doesn't look like it right now. Very, very marginally. Certainly not enough to sustain nosebleeds level in the economy. Okay, so there's the stock market explained and the bubble explained. Does it have any help to you? I don't know. Right? But at least you understand why it is doing what it is doing right now. Low interest rates, massive money supply, corporations either doing share buybacks or buying and investing in their companies so they can sell more product because of the cheapest interest rates. Okay? So, keep an eye on interest rates, keep an eye on the Fed. I personally thought that when the Fed started to get a little bit more hawkish, that we would have a bigger correction by now, but I stand corrected because the Fed has changed since 2017 and started raising rates. But we've just continued to go higher. And this is what really worries me the most. This overextension right here, based on the fact that we do have a Fed tightening policy, meaning that they are raising rates, yet the market is driving higher. So I do think this is going to end badly, very, very, very badly. When is it going to end badly? I'm not sure, but at least you guys understand why now, instead of all this conglomerate hype and whatever you're thinking it is, okay? The data is devoid. The real hard numbers is devoid from the reality of valuations. And whenever that happens, you got to look for the real reason, and then when that real reason starts to change, eventually that is when the bubble will explode, and that is the reality that we are in right now. And that changed about 2016, around 2017, when the Fed decided to become slightly more hawkish. When Janet Yellen leaves, I think we're going to really, really see a different Fed, I hope. The Fed becomes a little bit more, we got to get rid of all these doves in the Fed, because they're the ones that they're creating all of this imaginary bubble. And when it pops, don't blame businesses. Don't blame the banks. Don't blame anybody but yourselves for not speaking out. I don't care if you're a millennial. I don't want to hear nonsense. This is a bubble, and you're fueling that bubble by buying into that bubble. And when it collapses, and it will, and it won't be pretty, don't blame anybody. It's the Fed and your selection of government policy. You can go to your congressman. You can go to everybody, and you can say, look, this is not good. Okay? Yes, it's creating a lot of illusionary wealth, but it's not based upon hard data that supports it. And eventually, that ends bad. Okay, enough of my blabbering. Hope you guys enjoyed that. Thank you. This is why we are having a stock market bubble. When will it correct? I don't know. Will it correct? Abso-fucking-lutely. The only way it's not going to correct is if all that data that we're looking at, okay, all that data that we just looked at here, if that catches up with reality. And it's certainly got a long, long, long way to go. GDP's almost got to double, triple almost, to catch up with where we are as far as valuations are concerned. Okay? Thank you guys. Hope you guys enjoyed that. Please make this video viral. Please comment. You know, I love to hear comments, both good and bad. Appreciate it. Thank you. Bye for now.